our economy has evolved from our tax system. If you look at our system in 1986, when we had the last major tax reform, and you look at the major companies, the 5 biggest Fortune 500 companies, they're all US-based manufacturers. Now they're all technology companies. In an IP-based economy, it's really less clear where value creation takes place. So our rules that impose tax based on the residence of the company or based on the source of the company, they really don't fit very well with an IP economy. When American companies export, they're subject to their high corporate income tax rate, and they pay a value-added tax. When foreign companies import into the United States, they are subject to their lower corporate income tax rate, maybe no corporate income tax rate, and no VAT. So it looks like we're doubly taxed. They're not taxed at all. And it's against that backdrop that President Trump formulated his proposals. The basic ideas are, we're going to reduce your taxes. We're going to reduce them for individuals. We're going to reduce them for businesses. We're going to introduce business incentives to help you grow and invest and therefore create more jobs. And how are we going to pay for it? Well, we'll broaden the base. We'll charge a one-time reduced repatriation tax on the earnings that are offshore, the $2.5 trillion offshore. Now, the cost of these proposals is $6 trillion over 10 years. Now, $6 trillion is a problem because this is going to have to go through a reconciliation bill. And one of the conditions is that the bill, the revenue bill, cannot increase the deficit over 10 years. So if you're cutting taxes net over 10 years, the bill will sunset after 10 years. That's what happened with the Bush tax cuts. Everyone's attention is really fixated on the House. Once again, Ryan is a household name, and as the author of the tax blueprint that was first published in June of last year, he outlined a proposal that is really transformational. There's a lot in common with what President Trump campaigned for, but there are some notable differences. And the basic ideas on businesses is there are several tax decreases that are paid for with tax increases. The tax decreases are we reduce the rates on businesses and eliminate the corporate AMT, not only on corporate businesses, but on partnerships. We allow for immediate expensing of capital investments. By the way, those two ideas have a static tax cost over 10 years of over $4 trillion. And the next tax decrease is a move to a territorial system, which stops taxing foreign dividends from wholly owned subsidiaries and controlled subsidiaries. And that tax cost is $4.7 trillion. Now, scored dynamically, which takes into account the fact that when companies are incentivized, they're going to invest and they're going to hire more employees, and the employees are going to be paid more wages, and the increased wage tax and payroll tax, that balances it out and raises an additional $2 trillion. So the actual tax cost of these cost increases are $2.7 trillion over 10 years. That's still $2.7 trillion, so you have to pay for some kind of tax increases. And the tax increases are, first, to disallow net interest deduction for businesses, which is gigantic. If the bill just included that, that's all we would be talking about. To close the loopholes and to allow a one-time repatriation tax, and then introduce a destination-based cash flow tax with border adjustments. There are some differences between the president's proposals and the House proposal. Notably, a difference is in the rates. Another difference is on the interest deduction. I just have to say, the loss of the interest deduction is huge. At any other time, it would just consume our attention. It raises more money than the border adjustment tax, which has been talked about so much. And then the last piece is the destination-based cash flow tax with border adjustments, which I love that name. It's the best name in the history of tax names. But what I actually like about the name is that all you have to do is memorize the name and you understand what the tax is, because each phase of the name explains the tax. It is destination-based, which means that only U.S. transactions, sales and purchases, matter in the tax base. Foreign transactions do not. It is a cash flow tax, not literally a cash flow tax, but because there's immediate expensing of capital investments, that is very much like the cash system. And that has these border adjustments that impose rules similar to value-added tax, which tax imports and exclude exports. And the result is an enormous difference in the taxation of exporters versus importers. Just a quick picture to show how the same economic transaction is taxed differently. Assume a company spends $100 on labor and cost of goods sold, sells for 110. It's got 10 net income. okay? Assume the rates go down to 20%, which is the proposal in the House. They pay $2 in tax, they end up with $8 after tax. If a U.S. exporter has the same fact pattern, the sales is exempt. So they're going to end up with the same $10 of net cash, but they're going to have a deduction, an NOL, for their $100 expense, which is worth 20% of $100. So they're going to end up in a positive 30 position. And if it's a U.S. importer, the importer will pay tax on the sales amount. They're going to actually end up losing money. They'll be insolvent. And so, not surprisingly, the retail industry, the importer industry, has mobilized. And it seems, on the face of it, that consumers will be harmed. And the academic economists are almost unanimous in the view that the dollar is going to appreciate in value in an exact amount equal to the tax, and so it'll all be a wash in the end. And so in our situation, the U.S. exporter, instead of selling for 110, he'll be selling in a foreign currency that's reduced by 20%, and therefore they'll get fewer sales revenues, and their after-tax position will still be $8. And the importer will pay less for the import price, and their after-tax position will be $8. Everybody works out perfectly. If an exporter is operating at a loss, they'll be able to carry over the loss indefinitely. Nobody other than an economist actually believes this. So to have a tax legislation that is premised on an idea that people don't believe is really precarious. And that's really one of the issues with moving forward with tax reform, because there are no, as Sean Spicer said about healthcare reform, there is no plan B.